Do you know why Superman wouldn't dare invest in Bitcoin? Because his weakness is crypto. Hi everyone, welcome to your favorite YouTube channel. As you already know how we do it. We dish out nothing but the best for you all. In today's video, we will be analyzing cryptocurrencies. So please do us a solid by hitting the like button and the subscribe button. It goes a long way in helping us grow as a channel and to keep serving you better. Let's get into it. If I had invested $1,000 into Bitcoin, then when it started, I would have no idea how it worked. The cryptocurrency market isn't for the faint-hearted, because when you think you've made it in life in a few seconds, a tweet from an influential person drives all that joy away within a blink of an eye. And that is what is being referred to as a volatile market. For more than 100 years, the stock market has been one of the greatest wealth creators in some parts of the world. Stocks may have taken a backseat to house, oil, gold, or other assets for brief periods over the past century, but they've delivered the highest consistent returns of any investment vehicle. This is until cryptocurrencies came along a little over a decade ago. The emergence of Bitcoin, Ethereum, Dogecoin, and a host of other digital currencies have paved the way for once-in-a-lifetime gains. For instance, a $155 investment in Bitcoin at $1 would have been worth over $1 million when it hit $64,800 a token in mid-April. But over the past 2 months, cryptocurrencies have fallen off a cliff. Some would call this a natural pullback after a monstrous run higher. I have a different name for it: bubble pop. While there is no shortage of enthusiasts who believe digital currencies are the greatest thing since sliced bread, I believe the crypto market bubble has popped with the crash. And these are the imploding 10 reasons why the bubble popped. Number 1, there is a very minimal real-world utility. One of the most significant drawbacks of digital currency is that it's virtually useless outside a cryptocurrency exchange. Although we've seen a small number of high-profile companies or organizations accept Bitcoin or Dogecoin, the reality is that the total number of businesses accepting either is microscopic. Approximately 1,300 businesses globally have chosen to accept Dogecoin after 8 years, while another source found that 15,174 businesses accept Bitcoin as of December 2020. For some context here, there are an estimated 582 million entrepreneurs worldwide. Number 2, valuations relative to transaction data made no sense. Even though valuation is somewhat subjective, one glance at transaction data for the 3 most popular cryptocurrencies relative to payment processing juggernauts such as Visa and MasterCard would leave anyone's jaw on the floor. The latest report found that 1.01 billion credit transactions were processed daily in 2018, 700 million of which were handled by Visa and MasterCard. By comparison, Bitcoin, Ethereum, and Dogecoin are processing in the neighborhood of 300,000, 1.4 million, and 50,000 respective transactions on their blockchains each day. All the major cryptos combined can't hold a candle to the processing potential of Visa or MasterCard. Yet the big 3 of crypto have a higher combined market value than Visa and MasterCard. That makes no sense. Number 3, businesses have been slow to adopt blockchain. On paper, blockchain sounds great. On the financial side of the equation, it's a way to expedite the validation and settlement of payments. Rather than waiting up to a week for cross-border payments to settle, they could be resolved in mere seconds or minutes. Blockchain also has non-financial applications. Ethereum's smart contract-driven blockchain might be the key to one day unlocking supply chain bottlenecks. However, what sounds great on paper doesn't always translate into real-world success. Blockchain continues to suffer from a catch-22. Businesses won't adopt it till the technology is proven on a broad scale. But no business will abandon their existing and proven infrastructure to effectively be the guinea pig. Until the blockchain matures, big business will keep its distance. Number 4, there's virtually no barrier to entry. Aside from minimal utility, my biggest personal gripe with crypto is there's no barrier to entry. Anyone with the time to code can develop a blockchain and potentially a tethered token. There are almost 10,000 different cryptocurrencies in its system. While many aren't trading much, if at all, there's an insane number of potential competitors to Bitcoin, Dogecoin, and Ethereum, with the likelihood of many more to come. In short, the crypto space is constantly being diluted by an unlimited amount of competition. Number 5, centralization remains a problem. One of the many goals of cryptocurrencies is decentralization. This is to ensure that no one person or small group of people controls a network. Yet, according to data from a reliable source, ownership in Bitcoin and Dogecoin is fairly centralized. Just 2,155 addresses own almost 42% of all Bitcoin, while 66.6% of all outstanding Dogecoin is owned by only 99 addresses. It's possible folks are waking up to the fact that these financial experiments aren't as decentralized as they were intended to be. Number 6, Elon Musk is tugging at heartstrings. Another reason the crypto bubble popped is that it's been artificially driven by tweets from Tesla CEO Elon Musk. At first, Musk was all aboard the Bitcoin train. He purchased $1.5 billion Bitcoin for Tesla's balance sheet in February and announced that the company would begin accepting Bitcoin for electric vehicle purchases a month later. Then, after 49 days, he tweeted that Tesla would no longer accept Bitcoin because of the adverse environmental impacts of mining it. He since turned his attention to Dogecoin. The fact that tweets with little or no substance created and erased hundreds of billions of dollars in crypto market value would seem to indicate that a bubble has been brewing for some time. Number 7, not all governments are okay with crypto. The crypto bubble has also popped because some governments aren't okay with allowing cryptocurrencies to undermine their own central bank-backed currencies. A couple of months ago, China sent the crypto market into a tailspin after prohibiting banks and online payment channels in the country from offering any services related to the cryptocurrency industry. It should be noted that a lot of Bitcoin mining occurs in China, and China's far from alone. Turkey recently enacted a ban on crypto payments. Meanwhile, countries including Bolivia, Ecuador, Nigeria, and Algeria have effectively banned digital currencies. This trend makes the global use case for crypto unlikely. Number 8, there are no identifiable real-world correlations. Yet another issue with crypto is there are no readily identifiable real-world correlations. For example, we know that gold and the US dollar have an inverse relationship to one another. When the dollar is declining in value, gold is very likely rising in value. This is a correlation that's been established over a long period. Bitcoin, Ethereum, and Dogecoin don't have these correlations. Enthusiasts like to point out how crypto is a hedge against inflation, but they forget that Bitcoin has both risen and fallen when the money supply expanded rapidly or slowly. Crypto is driven by emotion and technical analysis, primarily because it has no real-world correlations. Number 9, leverage is haunting the crypto market. The cryptocurrency implosion can also be blamed on investors who are over-levered. Some of the most popular crypto exchanges will allow customers to use 50 to 125 times leverage on their actual account equity. While this isn't an unusual amount of leverage in Forex, where currencies move in fractions of a cent, it's absolutely ludicrous for crypto, which can move 3% in the blink of an eye. According to data from a reliable source, over 887,000 accounts totaling $9.4 billion in aggregate crypto assets were liquidated as a result of leverage-based margin calls on May 19th. Because of this insane leverage, it doesn't take much for things to go south quickly for the crypto market. Number 10, investors always overhype new tech. Finally, investors frequently overestimate the adoption of new technology. Though there is no shortage of people hyped up about blockchain, it's been more than a half decade, and the blockchain buzz hasn't materialized into meaningful enterprise usage. It takes all next big thing technology time to mature, and crypto will be no different. All these mentioned are the main reason why the crypto bubble popped, but did the bubble pop with the crash? Absolutely, yes! Let me take you down on how it happened. Bitcoin, the world's biggest cryptocurrency, has long experienced volatility. It has lost over 20% in the last few months and is driven down by half from its April peak of almost $65,000. Market players are citing jitters over China's expanding crackdown on Bitcoin mining and thin liquidity for the losses. For the newbies, technical analysts use the term death cross to describe when a short-term average trend line crosses below a long-term average trend line, signaling a change in price momentum. The 50 and 200-day combination often attracts the most attention. The death cross, a bearish technical signal looming in price charts, could point to trouble ahead for Bitcoin amid regulatory crackdowns and environmental concerns, and just as explained earlier, the death cross occurs when the 50-day moving average crosses below the 200-day moving average. If that happens, Bitcoin can enter bear market territory similar to what happened in 2018. There's nothing about a death cross that's unique to Bitcoin. Many traders use technical analysis to make decisions about whether to buy or sell an investment asset, applying the discipline equally well to stocks, exchange-traded funds, future markets, and other asset classes. Looking at charts for price movements can give them insights that they then use to seek to predict future rises or falls in the price of whatever assets they're looking at. Previous death crosses resulted in additional price declines of 70% in 2018 and 47% in 2019. The death cross in 2020 occurred shortly after the coronavirus pandemic-induced market crash in March, which proved to be a lagging signal at the time. Speculative reports suggest that Bitcoin could soon drop to $20,000, referencing the looming bearish cross of the 50 and 200 daily moving averages. On June 21st, Bitcoin's 50-day average fell below its 200-day moving average, triggering a death cross signal and causing reason for concern to some investors. The following week on Tuesday, its price fell below $29,026, temporarily erasing its 2021 gains, before climbing back above $32,000. There could be a host of contributors to the decline. For one, China has recently been cracking down on crypto mining, and it banned financial institutions from offering crypto services earlier this year. Bitcoin tends to be hypersensitive to headlines, particularly those involving Elon Musk or Tesla. Causes for the downturn aside, the emergence of the death cross on Bitcoin's price charts has some investors on edge, or perhaps moving to sell their stakes. Others have decided it's a good time to buy, or simply to stick with a pre-existing strategy. Isn't it a coincidence that the bubble that has been bubbling to pop since 2020 popped this year? And not only that, but popped with the cross-death crash of cryptocurrency? However, the crash of crypto made the bubbling bubble pop but calm down. It's not a death sentence. The death cross is a bad sign, yes, but it doesn't necessarily indicate a significant and steady depreciation over the long term. And that's a wrap, guys. Let me know what you think of this video in the comments section. Don't forget to hit the like and subscribe buttons, and also turn on the notifications icon and stay updated with our latest videos. Have a great day.